I'm Riley Kemmer, I'm a licensed loan officer, and we're back with another episode of Mortgage Support. We hope you're enjoying the series, and if you want your question to be featured on the next episode, make sure to comment below. Paula on Instagram asks, what are some things your buyers have done to accidentally sabotage their own closing? Luckily, I've never had a client do anything that we haven't been able to fix before closing before, but that doesn't mean it can't happen. Most commonly, I would say that opening new lines of credit before closing is probably the easiest way to sabotage your closing. For me personally, I would say 80 to 90% of the time, our close calls actually come from large unsourced deposit or our buyers transferring money around without really any trace or letting us know what they're doing beforehand. In short, it's very natural to get excited about your closing and want to go open up some new lines of credit, whether it's to buy furniture, maybe get a new car to celebrate, anything like that. What I would recommend is before doing anything major, talk to your loan officer, make sure you're transferring money correctly, and that anything you are going to purchase, they are factoring in so you don't run the risk of sabotaging your own closing. From user Crispy Cake Day on Reddit, they ask, my realtor recommended I work with their loan officer. Should I trust them or do they just want a referral fee? Referral fees between realtors and loan officers are actually prohibited. And for myself, and I assume almost every loan officer out there, losing your license over giving some kickbacks is not a risk any of us are really willing to take. Keep in mind, realtors don't actually get paid until you close on your loan. So most of the time when these realtors are recommending a loan officer, it is someone that they've worked with in the past and they trust to be able to close your loan in a timely manner, so at the end of the day, that realtor gets their paycheck. Again from Reddit, from user I Make Onions Cry, which is a great username, they ask, with the election over, are there any proposed policies that might change the housing market? I really like this question, and one thing that I've been kind of theorizing that might happen that I don't see many people talking about really comes down to supply and demand. The number of new homes being built are already struggling to keep up with demand. So potentially, if there's a giant labor shortage, then they could fall even farther behind what the demand is. If that happens, and keep in mind this is something that I'm hoping I am wrong about, then the price of houses is going to skyrocket simply because there's not going to be enough supply to keep up with demand. From YouTube, user Toes_4 asks, is there a limit to how many times you can refinance? There isn't actually a limit to how many times you can refinance, but do keep in mind that there is a cost associated with refinancing. So if you are doing it too frequently, you run the risk of actually costing yourself more money than what you could be potentially saving. From Reddit again, user White Collar Dave asks, why use escrow versus not? Are there true pros and cons to either option? For those of you that aren't familiar with an escrow account, its primary function is to pay for your homeowner's insurance and your property taxes. When you close on your loan, part of those closing costs are going to initially fund this escrow account, and then each month you make your mortgage payment, a portion of that is refilling your escrow account as it's making these taxes and insurance payments. The biggest benefit in my book for having an escrow account is you don't have to worry about potentially foreclosing on your home because you forgot to pay your property taxes, or God forbid something terrible happens with your house and you missed a couple insurance payments. You're always going to know that those have been made and that you're going to be covered. The one con that I can think of with an escrow account is it's basically a savings account held by a middleman, but there's no interest rate on it. So if you live somewhere that has a very high taxes or very high homeowner's insurance, you could have a decent chunk of money in your escrow account that's not making any return on interest. So potentially it could be better to have that money in your savings account, but that's only worth doing if you trust yourself to make those taxes and homeowner's insurance payments yourself. From Reddit again, user Manager on Duty asks, how many times does credit get pulled during the typical application process? There's two answers. There's a short answer and a long answer. The short is that your credit is usually only going to get pulled once during the application process, which is usually 120 days. That's how long a credit report is good for. The long answer is that there's actually a few different steps to that process where credit gets checked, but it's not necessarily a credit pull that shows up on your report. For instance, my process, first thing we do is a soft pull, which doesn't show up as an inquiry, but it gives us all the information we need to start that process for you. Once you begin to start putting offers in on properties, that's when the official hard credit report gets pulled. And again, that is going to be good for 120 days. And then lastly, a few days before closing, there's a credit refresh. So really, there's 3 different credit checks, but there's only really one hard credit pull throughout the process. If you do take longer than 120 days, your loan officer will end up needing to do a second hard pull. Thanks again for tuning into Mortgage Support. Make sure to check out our social medias where you can post your questions for our next episode.